I'm going to show you how I helped these pre-retirees save $4,000 a year in taxes and how I helped them from this movement build an account with over $1 million, assuming a specific rate of return, in retirement that they can use for whatever they want. I'm going to show you using their real tax breakdown, and I'm going to show you the future value calculation to get us to the future retirement bucket. Let's get into it. And I don't know why, for some reason, it's really been helping me asking you to make sure to subscribe to this channel. Your support has been phenomenal. Just you taking the time to watch this has been so helpful. So help me out. Let's get the channel big. I'm almost to 1,000 subscribers. Make sure to subscribe. I promise to only bring retirement planning value and a little bit of CrossFit. Let's continue. All right, let's go over the scenario first. These clients are partially retired. They're still very young. They're in their early 50s and late 40s. They were fortunate enough to be a part of some public employment, and they were able to get early pensions, which you'll see here. But one of the spouses is still working. They're going to make $88,000 that's going to go on their tax return this year. They have some taxable interest. Remember this Easter egg of $21,190. Remember this. Then they're going to get some dividends. This is their pensions. They get $126,000 a year of pension. They had some capital gains. Not much, but a little bit. So their total income for 2024 is $236,000. They're going to take the standard deduction of $29,000, and then their taxable income after that will be $207,000. So that means for 2024, their total tax is $31,870. That puts them in the marginal tax bracket of 24% with an effective rate of 15.3%. So let's review some really important information. Marginal bracket, 24%. This is where their next dollar will be taxed. So every additional dollar they make is taxed at 24%. So you get to keep 76 cents, 24% goes to the IRS for them to do whatever they deem fit. They're going to pay $31,870. Their salary is $88,000 and their pensions are $126,000 and their taxable interest is $21,190. The wages and the pensions are going to stay the same for 2025. But this $21,190, what in the heck is that? Well, let me tell you. Let's take a little sidebar. These particular clients have invested around $250,000 into some real estate investment partnership where they invested the money, $250,000. It's always $250,000, and then they get interest dripped to them. Seems about $21,000 every single solitary year, which you think initially, that's awesome, $21,000. I'm so happy about that. But remember, their $250,000 is always $250,000, and they get $21,190 every single year. And don't you see, that seems just a little bit crazy? So as you can see here, I've copied a scenario over. What if we got rid of this? What if that went away? What if we took our $250,000 back, and we'll get to what we're going to do with that. And what if that went away? If we scroll all the way down here, their tax bill goes down $4,800, and now they're in the 22% tax bracket. The 8% annual yield that they're supposed to be getting from this real estate investment in some capacity is not actually 8%. It's far less. It's closer to about 6% with their after-tax yield. So you're not getting $21,000, you're getting $17,000. Overnight, by getting rid of this, they're going to save $4,000 a year in taxes. Unbelievable. So then you're probably asking, what in the heck do we do with the $250,000 if we took it out? Took it out of the real estate trust, because remember, that's their basis. So taking the $250,000 out is not going to be a taxable event. What should we do with it? So this is one of my favorite tools on the internet. It's a future value calculator. These people are in their late 40s and early 50s. So getting them to their late 60s and early 70s in retirement is not an unreasonable thought. In fact, statistically, they're most likely going to be there. So what if we took for 20 years that $250,000 and we didn't really mess with it. We just invested in a diversified portfolio, diversified ETFs, high quality, diversified domestic and international ETFs. We average 8% a year, and we didn't add another cent to it. That turns out to be $1.1 million in an account with their names on it, with complete control and flexibility. Now, let me throw this disclaimer out there. I know. With an account like this, in a taxable brokerage account, they're going to pay some interest and some dividends. But let me show you what that would look like. What if in a year they got $10,000 of dividends? Because you do. When you invest in high quality diversified ETFs, you most likely are going to receive a very small dividend, maybe 1%, maybe 2%, depending on the fund. But what if they did receive some dividends, say $10,000 worth? They're still in a lower marginal tax bracket, and they're still going to save almost $3,000. So not only is your tax bill still going to be smaller from the original version with the taxable interest, but you're also going to have a bucket of money that's continuously growing. And if you ever sever off any capital gains for income in the future, you can actually use up to a certain amount of capital gains that's only going to be taxed at 15% a more favorable rate. If you make too much income, then it gets up to 20, maybe 23.8%. But in general, you're going to have a more favorable tax situation, a bigger pot of money, more control, more flexibility, and you're going to save a bunch of money in taxes right now while you're working, and it's going to drop you into a lower tax bracket by making sure your money is put in better places. Simplicity is genius. This is one way that we can plan productively for retirement earlier and help you to be in a better situation once you get there. If you want me to help make decisions like this, please contact me below. That's what I'm here for. Thanks for watching. Like and subscribe. We'll see you next time.